At this moment, Tilray Brands Inc. is trading at approximately $1.22, showing a decline of about 3.2% for the day. Now, most people see this and immediately think it's just another tough day for a cannabis stock, another dip in a volatile and often disappointing sector. The common expectation is that this is simply par for the course, a predictable swing in an industry that has yet to deliver on its grand promises of widespread legalization and profitability. The headlines often fixate on the latest setback, a missed earnings target, or a regulatory delay, and it's easy to fall into that narrative. But what's really happening beneath the surface, and what that intraday price action doesn't tell you, is far more nuanced. While the stock price is down, the underlying trading volume is still significant, indicating a high level of institutional and retail activity, but it's not the frantic sell-off one might expect. Instead, it's a grinding technical slide, one that points to a consolidation of sentiment rather than a panicked exit. The real story here isn't just about cannabis. It's about a company that is actively trying to redefine its entire identity, a fact that the daily price chart alone can't convey. Tilray is no longer just a cannabis pure play, and that is a reality that is slowly and sometimes painfully being priced into the stock. The general belief, particularly among retail investors who perhaps first got into the stock through online investing platforms like Robinhood or SoFi Invest, is that TLRY is a direct bet on the U.S. federal legalization of cannabis. This has been the central thesis for years, the primary reason for every bull run and subsequent crash. They see every piece of news about potential government action and assume it will translate directly to the stock price. The reality, though, is much more complex. Tilray has been aggressively diversifying its business, a strategy that is simultaneously a hedge against regulatory stagnation and an admission that the U.S. legalization narrative is not a reliable growth driver. The company has made a series of acquisitions in the craft beverage space, beer, spirits, and non-alcoholic drinks, to build out a different kind of consumer packaged goods company. This move has created a new kind of tension in the company's story. On one hand, it's a smart defensive move to generate stable revenue and reduce reliance on a single, politically dependent market. On the other hand, it dilutes the very reason many investors are interested in the stock in the first place, muddying the pure-play cannabis thesis and making it less attractive to those looking for a high-risk, high-reward speculative position. The current price action is a reflection of this internal conflict, a struggle between a company trying to become a mature, diversified business and an investment community still holding on to the original speculative dream. Looking at the recent stock movement, the decline today follows a broader trend of pressure on the cannabis sector as a whole. There's been a collective exhale from the market after a recent wave of optimism about federal reform cooled down. Volume has been elevated, but it's been more of a distribution than an accumulation phase, with sellers seemingly outnumbering buyers on the small intraday movements. Institutional money, which had shown some renewed interest, has largely been on the sidelines, waiting for a clear signal. They aren't selling off in a panic, but they aren't stepping in to buy the dips with conviction either. This creates a technical environment where the path of least resistance for the stock is often down. The stock is well below its 52-week high, but also comfortably off its 52-week low, which suggests a consolidation range is forming. The daily candles have been showing long wicks, indicating indecision and a tug-of-war between buyers and sellers throughout the day. This isn't a stock in freefall, but it's a stock without a clear direction, moving on the whims of short-term traders and sector-wide sentiment rather than any strong company-specific catalyst. You can see similar patterns in other major cannabis players, but Tilray's story is unique due to its aggressive pivot towards alcohol and other consumer goods. That shift is what makes its trading chart look a bit different from a Canopy Growth or an Aurora Cannabis, which are still much more tied to the cannabis industry's fortunes, for better or worse. This brings up an interesting question. With all of the platforms available today for self-investing, from Fidelity Investments to Interactive Brokers, how many of you who are watching have an investment in a cannabis stock? Comment below how many shares of Tilray or any other cannabis stock you currently hold. Now, let's take a step back and talk about what the company actually is. Tilray Brands, as the name suggests, is a global cannabis and consumer packaged goods company. Their primary business segments are medical cannabis, adult-use recreational cannabis, hemp and wellness products, and a growing portfolio of alcoholic beverages. Their brand lineup includes well-known cannabis names like Good Supply and Broken Coast, but also established beverage brands such as Sweetwater Brewing Company and Breckenridge Distillery. The acquisition strategy, particularly the merger with Aphria, has been a central part of their recent history, creating a much larger, more diverse company with operations in Canada, the United States, and Europe. This diversification is the core of their strategy, moving away from being a single product company to one with multiple revenue streams. The past performance tells a story of significant acquisitions and a constant struggle for profitability. While revenue figures have grown, primarily through these acquisitions, the company has consistently posted losses, often sizable ones, due to high operating costs, goodwill impairment charges, and restructuring efforts. The company is trying to manage its financial structure to maintain stability, but the path to consistent profitability remains elusive. They're playing a long game, betting that their scale and brand diversity will eventually lead to consistent positive cash flow, but the market's patience for this kind of long-term strategic play is wearing thin. This is a common theme with these companies. The initial promise of growth often comes with a hefty price tag, and that price tag is paid for in years of red on the ledger. Looking ahead, the future outlook for Tilray is tied to two distinct narratives. The first is the one everyone knows, the U.S. federal cannabis legalization story. Any significant progress on this front, be it rescheduling, descheduling, or legislative reform, would undoubtedly be a major catalyst. It would open up the massive U.S. market, which the company is currently restricted from operating in at a federal level due to its cannabis business. The expectation is that this would send the stock soaring. The reality, however, is that while Tilray is poised to enter this market, they would face immense competition from established U.S. multi-state operators, MSOs, who already have their infrastructure and distribution networks in place. This isn't a guaranteed home run, it's a competitive battle waiting to happen. The second, and arguably more realistic outlook, is the success of their diversification strategy. The company's growth now is more dependent on whether their beverage and wellness divisions can consistently grow revenue and, more importantly, contribute to the bottom line. Can Sweetwater Brewing Company and Breckenridge Distillery become cash cows that subsidize the cannabis operations and help the company become profitable? This is the less glamorous but more dependable growth story. If they can show consistent, profitable growth from these segments, it would dramatically change the investment narrative, shifting it from a speculative bet to a more stable consumer goods play. The risks, of course, are numerous. The regulatory environment remains a constant threat. A change in political winds could delay legalization indefinitely, leaving Tilray to rely on a slower, more difficult growth path. There's also the risk of competition. The beverage industry is incredibly competitive, and Tilray's up against major established players. In the cannabis space, the market is fragmented and intensely competitive, with many companies fighting for market share. On a broader macroeconomic level, a broader economic downturn could hurt discretionary spending on both cannabis and craft beverages. For a company that is still burning through cash, this could be a serious problem. The opportunity, however, lies in executing on their current strategy. If they can successfully integrate their acquisitions, find cost synergies, and show a clear path to profitability, the market will eventually recognize the value of their diversified portfolio. For those of you who manage your own finances with something like a Schwab Intelligent Portfolio, or perhaps use the Fidelity mobile app to check your balances, it's important to understand this isn't a simple stock. It's a complex, multifaceted business with a lot of moving parts. The real story of Tilray Brands isn't about the dramatic spikes and crashes anymore. It's about the slow, methodical work of building a business that can survive in a tough, unpredictable market. The challenge is that the market wants the excitement of the old narrative, while the company is trying to build a new, less exciting one. The tension between those two realities is what's keeping the stock in its current state of flux. The expectation of a sudden catalyst is constantly in conflict with the reality of grinding out incremental improvements, and until that changes, the stock will likely continue to trade with this kind of volatility and lack of clear direction.